Please note, the information provided in this podcast is general in nature and should not be taken as personal financial advice. Hello, and welcome to another PFS podcast. I'm Paul. I'm the Paraplanner and Project Manager at Progressive Financial Solutions. Today, I am joined by David Bassanese. David Bassanese is one of Australia's leading economic and financial market analysis. He's the Chief Economist at BetaShares, and he previously held roles at the Federal Treasury, Organisation for Economic Cooperation and Development, and also Macquarie Bank. Thank you for joining us, David.
Great to be with you, Paul.
So the last 12 to 18 months have seen one of the most wildest rides in economic history, not only on the COVID front, but throughout financial markets and the economic markets. So today we're going to be looking forward to the second half of the 2021 financial year. So David, what do you see as the biggest risks to the economy and to the financial markets for the rest of this year? And then how do you see the rest of the year transpiring?
Yeah, look, there's always, as they say, equity markets climb a wall of worry. So there's always things to worry about. And in moments when you think there's absolutely nothing to worry about is when the markets are probably at their, at their highs. But look, the key worry at the moment is the US inflation picture. I mean, US inflation has leapt in the first few months of this year. I mean, even further than many anticipated. The hope is that dies down, like it is transitory. And what I mean by basically you've had demand run ahead of supply. So a lot of supply, international trade is still congested. Factories are still struggling to get back up to speed. And so you've had a lot of supply demand bottlenecks, which have pushed up certain prices. Used car prices, for example, in the US have gone up 40% over the past year, which has been a big chunk to the underlying inflation measures. But provided that, if that doesn't die down, like if that persists, then bond yields will go up. The talk of the Federal Reserve in the US tightening interest rates will get more heated, and bond yields going up will be a threat to the equity market because valuations of the equity market are pretty high, but justified by bond yields staying low. So that's the worry, that if bond yields do go up because inflation hangs around longer than expected, that's going to put downward pressure on equity valuations, which could see the market come off. The positive news here is that economic growth, globally, is certainly rebounding very strongly from COVID. COVID's obviously always still a risk. New variants that are immune to vaccines, we wouldn't want to see. That's obviously a risk on the demand side. But assuming that holds up, assuming we don't get that, the growth outlook in the US in particular, but also globally, is very, very strong. Corporate earnings are very strong. So that's going to be supportive of the market. The risk is what happens with interest rates and valuations. So again, just on that point, I do think inflation will die down in the US. I think it is largely transitory. And as a result, bond yields will go up a little bit, but not by enough to derail the equity, ongoing, grind higher in equity prices.
Yeah, so obviously that's the most talked about point in the global financial markets at the moment. So the risk of inflation is there. We hit, I think it was 5% as the most recent figure of year-on-year inflation, which is the highest since 2008. So many in the market, the consensus view is that inflation is transitory. So I'm believing that you're also in that camp, that we just see inflation for the next 12 to 18 months, and then it will go back down to the US Fed's target rate of 2 to 3% average inflation. But if we do see sustained inflation, which we are obviously, when building portfolios, you've got to consider that as a risk. And you've got to build portfolios around the view that inflation may actually be sustained, because there's heaps of factors. When I'm thinking about it, I think, okay, consensus views inflation is transitory. Markets are built for that. Markets will not react overly if inflation just dies off after 12 to 18 months. That's what they're expecting. But if I'm thinking about labor shortages, underinvestment in commodities, Biden's fiscal policy, which we haven't seen fiscal and monetary policy be together for that long. So what risk that will have on inflation moving forward. So what do you see as the factors that need to be together to see inflation for the longer term?
Yep.
And then what economic risk will longer term inflation have on the financial markets, and what will the resulting be?
Yeah. Look, I think when you think about inflation, there's two elements to it. Firstly, there's these, as I've said, the short-run supply disruptions. So things like used car prices in the US going up, all hotels and restaurants putting up their prices at the same time after having had to slash their prices last year, lumber prices going up because of lumber shortages. So these are like transitory one-off, reopening things. The longer-term inflation challenge is ultimately the labor market. This is why the US Federal Reserve and even in Australia, they don't see inflation being a sustained problem until we get clearly tight labor markets and wage inflation picking up. And so in the US, unemployment is still over 5%. When it gets to, sub 4% is usually rings alarm bells, because it means that the economy's reached its end of its, spare capacity. So that is the longer term issue that will ultimately, cause inflation to pick up if we get a tight labor market and accelerating wages. Now, how the Fed responds to that is to slow the economy down. That's when you will get rate rises. If we get to that point, you get rate rises, you get the economy slowing down, and you'll probably get a deep correction, if not bear market, in the equity market at that point. Now that is a normal type of cycle with inflation. Now the other thing I'd point out is a lot of people, I guess the worst case scenario for markets is the sort of 1970s, where we had high and rising inflation for 10 years or more. Now that really was supply shocks. I mean, you had OPEC, triple the price of oil overnight, and oil was obviously a bigger part of the global economy back in the 70s than it is today. So to get that really stubborn, apart from the labor market, the other type of thing that could cause inflation would be these sort of supply shocks. But to be honest, I don't see the repeat of the 1970s style supply shocks, likely. And oil is a smaller part of it's still important, but its importance to the global economy is not as great as it was 50 years ago. Services are a lot more important. So so I go back to central banks at the moment are relaxed about the inflation outlook until such time as we get clearly tight labor markets, tighter labor markets than we've got at the moment, and signs that wages pressures are starting to accelerate, which could still be 2 to 3 years away.
Yeah. Okay. So you do obviously view that inflation is transitory. We've highlighted some of the risks. The risks are there for the markets.
Yep.
If inflation does turn out to be sustained, that is the biggest risk, obviously, for the markets in terms of an economic and financial market downturn. So we'll move forward because asset price valuations have been heavily supported over the last 30 years through global bond yield. So January 1990, we saw bond yields at 17.5%, I'm pretty sure it was. And from there, now we see bond yields, 10-year bond yields in the US at 0.1%. And another risk to the financial markets, and they're starting to talk about it, is the Fed beginning to taper their asset purchases. Yeah. They're talking about that at the Jackson Hole meeting in August. That could be a potential outcome from that. So as we move to later in 2021, how do you view that the Fed beginning to taper their purchase of bonds and other sorts of assets?
Yeah, look, you're right. So bond yields have just been trending down for several decades on the back of low inflation. I mean, again, the inflation of the 70s and 80s was crushed in the 1990s due to globalization, technology, these sort of structural factors. And central banks have been trying desperately to get inflation back up in the last few years, and have just been cutting rates lower and lower with every cycle. And that's why interest rates are now incredibly low. They may back up a little bit when they start to renormalize, lift short-term interest rates from the emergency levels last year. But again, going nowhere back to where they were a few decade or so ago. But just on the tapering, I mean, this is, I guess, the nearer term issue for bond markets. And look, as you point out, at the moment, the US Federal Reserve is buying $120 billion US of bonds every month. And it's been doing that for a while now. And as the economy recovers, it's going to scale back those bond purchases. And that's the bond tapering that we're talking about. And I think it will be announced. It could even be announced next month, as you point out, or maybe a bit later. But I think the central bank ultimately, again, provided it still assumes inflation isn't a problem, like a sustained problem, it's going to want to do that tapering as gradually and as slow and as carefully as it possibly can, not to upset equity markets. So obviously everyone is worried about the tapering and what it could do to bond yields, but I think the Fed will telegraph well ahead of time what it's going to do, and then what it does will be very glacial. So, for example, instead of buying $120 billion a month of bonds, it'll say we're going to buy $10 billion less every month for the next 12 months. So that way, over 12 months, you go from 120 billion to nothing, and so it's a gradual, process. That's what I anticipate they'll try to do, because ultimately, the Fed doesn't want to cause a big sell-off in equity markets. It doesn't want to disrupt investor sentiment, because ultimately it still wants to have the economy get to a full employment situation and wants to get inflation sustainably up. So it'll try that. Now, that's to say the market may not still have a taper tantrum, as it's called. A few years ago, when the Federal Reserve started slowing its bond purchases after the GFC, it did cause a taper tantrum, as it was called at the time. Bond yields went up and equity markets went down. So there's a risk that will happen, but the Fed at least will be trying to avoid that happening.
Yeah. So as the Fed does move forward to taper, which we do expect to happen probably later this year, do you expect the 10-year bond yield to gradually rise? Because the Fed has supported a low 10-year bond yield because they're purchasing such a great amount of the actual available supply. So do you see the 10-year bond yield starting to gradually rise? And at what point will the 10-year bond yield get to? So what point will it get to where you expect that we'll see a fall in equity markets, say 10 odd percent, just because the value of the bonds have gone, well, the yield on bonds has gone to whatever, 2%, 2.5%. That's what we're hearing a lot of in the financial market world. Around that rate, where we expect maybe we can get a sell-off in equity markets. Where do you see the bond yields going to, and what level do you see the bond yields affecting equity markets as a whole?
Yeah, look, good questions. And now the Fed themselves have estimated the effect of their bond purchase, and they reckon it's probably around 25 to 50 basis points. So they think that their bond purchases, and the RBA have done similar work here because the RBA has been buying bonds as well. So they think it's of the order of 1/4 to 0.5%. So if they stop buying bonds overnight, that's maybe 50 basis points on 10-year bond yields, which means US bond yields go from 1.5 to say 2. Now, again, they're not going to do it overnight. They're going to do it gradually over maybe a course of a year. So you could figure that, if we purely look at it mathematically, I mean, there's nothing hard to be precise on these things, that maybe just through the bond purchases going from, 120 to 0, we get 50 basis points on 10-year bond yields gradually over the course of the year. So that would push up bond yields to say 2%. Now, my line in the sand has been around 2%. I mean, basically, I think and again, my view has been that 10-year bond yields in the US would end the year still sub 2%, around about 1.75%. And provided that happens, then equity valuations can hold up. So that, again, the PE ratio in the US, the price to forward earnings ratio, is around about 21 times earnings, which is quite high. It's not too bad given where bond yields are, but again, so the more the bond yields rise, the greater downward pressure will come on that PE ratio. But so my line in the sand is 2. Once we get above 2, I think the markets you'll need a valuation adjustment in the market. Now, what will I think the biggest worry for the markets is, or not worry, but the biggest adjustment for the markets will come not when they taper, but when they eventually start raising short-term interest rates. So when the market starts to price in interest rate increases within the next 12 months, my modeling says that 10-year bond yields can easily go to 2.5% in the US, and that would be enough to see a correction in the market. So again, when the Fed starts renormalizing short-term interest rates, which as you pointed out are of a 0.1%, or effectively zero, if they move that up to 0.25, 0.5, even to 1% over the course of a year, that should put downward pressure on equity markets. But again, I think it would be just a correction of around about 10, possibly 15%, in an otherwise, still expanding economy. But yeah, the market will need to adjust to a change in the interest rate, from very, very low levels to still low, but still somewhat higher than what they are. So it's the Fed tightening, which will start to signal maybe in possibly a year's time. It could be that far away that will be possibly the real challenge for the markets.
Yeah, and you mentioned just before the short-term interest rates rising. We did see that briefly. It was a couple of weeks ago when the Fed said they were talking about normalization of interest rates. So, and we saw a big adjustment in equity markets. I'm pretty sure banks sold off, gold sold off. Surprisingly, technology actually lifted off from that. So if that was to happen, and that's your view, what sectors of the market do you see will benefit from that, and what sectors of the market will you see will have a disadvantage and negatively impacted from that?
Look, when we get to a period of, at the moment, what's happened is we had a bit of a bond scare in around February, March. Bond yields went up quite aggressively. And we saw the growth areas, technology and growth, for example, sell off. And so that we saw a so-called rotation to value parts of the market, things like energy and globally financials. And so if you are in a rising inflation, like for example, if inflation does stay uncomfortably high and bond yields do go up, then things like global banks, funnily enough, tend to benefit from widening interest rates because their net interest margins expand. And commodity type exposures, things like global oil producers, gold miners, global gold miners. So these are all thematics that you can get exposure to through things like exchange traded funds. We have some of those. So those are the things that I think will do well if inflation and bond yields do become a concern, will do relatively well at least. If inflation does remain contained, and again, if bond yields don't rise too far, too fast over the next year or so, then growth, may storm back into, perform well. So things like the NASDAQ in the US, the Australian technology sector here in Australia. Again, these are all things you can get exposure to through ETFs, but those sort of, so it's really a growth versus value type of debate at the moment. And so in a benign inflation interest rate world, growth will do well. So technology can do well, things like emerging markets even. And otherwise there's the value, things like energy and financials. That's the way I kind of think about the markets.
Yeah, exactly. So that's the way we're kind of viewing it as well. So as we discussed at the start, the most important thing in the markets at the moment is inflation, because we get higher than expected inflation, we're going to get higher bond yields in the US, and that's going to affect all sectors of the market. And it's going to determine if you're going to get outperformance over the next 3, 4, 5 years. And building a view of what you expect, how do you expect the economy to be, and how do you expect bond yield and inflation to be is the most critical point and part of building a portfolio that's going to provide you with alpha over the next few years. So we'll move on to probably the most fascinating topic for most Australians, which is the Australian housing market, which has been the most bullish market for the last 30 odd years. And last year, even between COVID, I think Australian house prices rose approximately about 14% over the 2020-2021 financial year, we do have yields where they are 0.1%, which has been totally supportive of the Australian housing market. So, and we can't really see yields going lower than 0.1. We're basically at our lowest point right now, unless they go to Japan and go negative. But where do you see the Australian housing market being in the next 5 years, and what's your overall view? Is it positive or negative? And do you reckon we'll get a stalling of house price growth in Australia, or do you see the growth continuing over the next 5 years?
Yeah, look, first and foremost, I mean, what drives house prices to me is not immigration. It's basically in major capital cities like Sydney and Melbourne, we're supply constrained, right? It's hard to build new houses easily close to the city where people want to live and work. And as a result, prices come down to affordability. I've always said that. The price of a house in Sydney and Melbourne is determined by the maximum amount that the average homeowner can afford to pay for a mortgage, right? So when you go to a property auction, the last person standing at that auction is the one who's squeezed the most out of their budget to be able to pay for that house. And that's the way it works. And what happens as a result, when interest rates fall, all of us, people don't say, oh, you know what, I can spend less on my mortgage now because interest rates are big. No, they go out to the property auctions and bid more for property because they've got this budget, you know, say at 30, 40% of their after-tax income, some enormous number that they can budget for. So historically in Australia, it's affordability driven by interest rates that have driven prices generally over time, and we've had bubbles in between. So that's the backdrop to what's happened. And so if you look at house prices in Australia prior to COVID, we'd actually gone sideways for 5 years, relative to income. So they were pretty flattish. I mean, we've had cycles, but generally over that time they've been flat. And then we've had the big interest rate cuts from the RBA. And so affordability, home affordability suddenly improved by a lot. And now you've had the V-shaped recovery in the economy. It was like the perfect conditions for a housing rebound, a very strong housing rebound. And that's exactly what we've had. And so I think this will continue to play out until those affordability measures get to points where, again, the average household can't afford to pay more for a property. That's given where interest rates are. And as a result, we're not there yet. So there's probably another 10 to 15% upside in interest in house prices, given where interest rates are at the moment. Now, what that means is when and if the RBA does eventually raise interest rates, it will take the steam out of the market pretty quickly. You won't have a housing crash, but you'll have a leveling off of prices, maybe a bit of a decline. But basically, that will immediately affect the affordability for many people in terms of bidding more for property. And what was interesting last year is that, we've long said you won't get a housing crash in Australia until you get a recession and you get a big spike in unemployment. Well, we had that very briefly last year, and house prices declined by about 5% nationally, not by a lot, because we had all those interest rate repayment holidays by the banks. We had the JobKeeper programs. We had a lot of policy support such that people didn't need to basically sell their houses by the thousands because they could no longer afford their mortgage. And that's what prevented house prices from declining last year. And I think going forward, there's a little bit of a, should we get another recession for whatever reason, you may find that those policy supports kick in again just to keep supporting the housing market and avoiding a big crash. So I think the market generally goes up now in a staircase type fashion. We get periods of relative flatness where prices go sideways to modestly down relative to incomes when interest rates are rising. And then when we get, interest rates decline, you get that catch-up period of prices going up. So I'm pretty, so bottom line, it's hard to be bearish on the housing market, although things on an outright basis look pretty expensive, but on an affordability basis, it's a bit like the equity market. Like equity market looks expensive, but low interest rates have brought us to where we are. And it's the same situation with the housing market.
So that's what I see as well. Like as long as interest rates are supportive, the government's supportive with their program stimulus, JobKeeper, JobSeeker, house prices will continue to be supported over the medium term. I do see a bit of a longer term, little bit of a bearish view on the housing market, just by the pure fact that millennials and kids are a bit, I don't really want to buy a house at the moment because it's too expensive. And then we've got people moving into baby boomer stage and moving to a stage where the supply is actually going to come on as our older generation become older and older. You start needing to sell houses, downsize. So that's what I'm seeing a little bit over the longer term, but yeah, medium term, I think house prices will just continue to be supported by interest rates and by the government.
Just a quick point on that also. I mean, it often gets overlooked in the reporting of prices in Australia, why they're so unusual. We're a very urbanized country by global standards. Like a lot, we think we've got a big country for the small population, but the problem is we all cram into the major cities. So if you look at the US, our congestion, our level of urbanization is a lot higher than the US. So we're very centralized, and as a result, proximity to major capital cities is at a premium. And then we've got the supply constraints in terms of, not being able to build high-rise apartments easily in the suburbs, for good or bad. I mean, people say we should be able to do it. People say we shouldn't. They don't want to change the character of their neighborhoods. But it's a combination of being highly urbanized, everyone wanting to live in Sydney and Melbourne, or even the other major capital cities, not having a lot of other cities, and then having supply constraints in building higher within those cities, which is ultimately what's keeping prices relatively elevated by global standards.
Yeah, exactly right. So everyone wants to pay a premium, and will pay a premium. If you're going to live, I can live 10, 15, 20 minutes away from the city. If I can live that far away, I'll pay a premium. I'll pay the extra couple $100,000 on my home.
Yes.
For the same home to live just closer to the city, ease of travel to and from work. But yeah, so what we'll wrap up today, and thank you, David, for joining me today. And as I mentioned at the start, David's the chief economist at BetaShares, and BetaShares is one of the great suppliers of ETFs in Australia, and probably Australia-wide is the #1 supplier of ETFs. They hold 62 ETFs and very popular ETFs, including the shorts that are very popular among investors, and they've got many ETFs surrounding global themes and all that. They have currently about 19 billion funds under management, and they were established in 2009. So I'll put the link in the description to the BetaShares website, and have a look at some of the ETFs that they run. And they're a great, well-run company with a great chief economist who, thank you for joining us today.
Good to be with you, Paul.
Thanks, David. Thank you.
Good luck out there. Bye for now.
Thank you. Bye.